Hello and welcome. It's the 1st of March. You're watching India Market Open, and what a day it's been yesterday. We started with caution from the Sebi, ended with a very strong GDP number, and of course markets did a U-turn. So we start March on a 50-50 note, I'd imagine.
Yeah, I'll pour some cold water at the end of all of this, but yeah, the cues thus far, guys. You couldn't have asked for a better setup for Friday, right? Global markets, GDP, our markets ending on a high. That was perfect.
Yeah, and that's great because Feb has otherwise not been a very exciting month for Indian equities. It's been volatile, and generally you have the IDs of March. So there's a lot of trepidation going into March, but definitely after those rocking, there's no other word, rocking GDP numbers yesterday, we're looking set perhaps for a better March, and we'll come to it in more detail.
Tamanna, I think it's still a divided house, right? Because a lot of people say the numbers only justify current valuations. Now, whether this is going to give the next leg up to the rally is anybody's guess. I have my doubts, but we'll discuss that.
Yeah. And okay, so from market's perspective, yes, but the fact that India is growing at this pace, despite everything,
from the Barclays to the city, everyone seems euphoric, but we'll talk about that over the course of the next hour.
Of course.
Quick check on implied Nifty before I toss it over to Tamanna for global cues. It looks like it's going to be a good start. So I think we're taking heart from the fact that the markets, after a very smart recovery in the last hour of trade, are indicating to a gap up this morning. Small gap up, but nevertheless, and it's also Friday, so I think there'll be lots of factors playing out today.
And superb cues from the US overnight, if that's something that the market is looking out for. Feb has been fantastic for Wall Street, no doubt. The Nasdaq ended on a record high, closed on a record high. You've had the S&P also close at a record high, so that's been great. Once your mic's a little, so that's also been fantastic. So the tech stocks rally continues unabated is one way to put it, and we'll just pull up what's happened through the month, through February for the US market. So that's the Feb for Wall Street, at least Nasdaq up 6%, 5% on the S&P 500, and the Dow up 2%. So important data came out yesterday. PCE is something that the Fed watches. It's the personal consumption expenditure, sort of gauge of how people want to spend. So it rose 0.4% as per expectations. It's also an inflationary gauge. So the 2.8% figure that it ended up at, so not higher at least, but it's still above Fed's comfort level. And that then has now definitively pushed the cut expectation to summer, so June maybe, not before that. So, not too much of crying over it, though, anymore, and that's the important bit. So you saw the US 10-year inched up very, very slightly because of this at 4.26%. Crude has also been up in the month of Feb. I'm just going to give you the Feb picture to understand what's happening next, because OPEC Plus is going to meet. Expectedly, for another quarter, we'll have production cuts, and that might go on through the year, actually. So crude want to keep an eye out on. Asian markets are looking good, broadly looking good. Definitely. China data came in on their manufacturing, and that's slightly lesser than expected. But on the other hand, if you just pull up what's happening in Asian markets, not too bad at all. Nikkei, of course, the continuing champion. We should do a deeper story, really, what's happening there. Quick look at fund flows before I hand it to Niraj for the trade setup today. And, we were talking about how the close was decent, and you had buys from FIs to this extent after a while. So about 3,500 crores from FIs, DIs, 230 crores. DI is a whole different story, because I think a lot of the industry, from what I'm hearing, is still trying to figure out what's happening with their small cap and mid cap funds and where they go next.
Yeah, yes, indeed. But, what happens in the US when the US sneezes, the world catches cold, and vice versa. And for me, when Ray Dalio says something, I stand up and take notice. Most people should. And so much talk around what the US markets are doing. Ray Dalio in a LinkedIn post says, and I think we have his quote made, wherein he says that when I look at the US market using these criteria, there's some criteria that he follows. There's a hyphen. We've done a comma here, but nevertheless, he says which is the US markets, and even some parts that have rallied the most, which is he's referring to the tech stocks. He's saying it does not look very bubbly. So Ray Dalio, of all people, is saying that US markets does not look out of whack, which is a tall statement from a tall finance veteran coming in. So maybe, just maybe, if indeed some behemoths don't believe that US markets is in a bubble. And if the US market stays steady, we might have some good news to follow as well, because we don't have global stress to deal with. Now, the trade setup for the day today, well, global cues, strong GDP data will all aid the mood today. So no surprise there. Samina already mentioned the implied Nifty open, which is about 47, 48 odd points. Yesterday, we spoke about how PCR was at 0.66, and that led us to believe that markets may not really fall too much, and they didn't. Now, the PCR has jumped to 1.09, by the way, in a single session. So expiry-related moves keep on happening. But the point is, quant indicators still indicate upside possibilities. So watch out, maybe, just maybe, the chances of an upside relative to the downside are a lot higher. So that's the other thing to keep in mind. Yesterday, we spoke about how autos may have a good outing, considering the expectations that people have from what the Feb data will be, and we'll talk about that too. So autos revved up on expected lines, but I reckon that if the monthly sales numbers come out as expected or better, you might actually have the auto index continue with its momentum. So that's also to be watched out for. But guys, in speaking about Feb and March and what the moves happen in either of these months, here's some data. The last 4 years, and even if you discount the COVID year, the last 4 years, we've seen a temporary top form in February and a fall come in March.
Yeah, the IDs of March, that's what I was saying.
So look at this. And it's true for the last 4 years. Feb 2020, the high was 12,246. The March low was 7,511. Now, that was a 38% fall. And you can argue that, chalo, that was the COVID year, so it was to be anticipated. 2021, Feb 2021 high, 15,431. The April 2021 low, 14,151, which is about an 8% downtick. 2022. Feb high, 17,794 on Feb 22nd, by the way. And March 2022, which was, I think, on March 8th, the level was 15,671, which is a 12% fall. And 2023 as well. 18,134 was the Feb 2023 high. The March 2023 low, 16,828, about a 7% fall. We've done about 22,217, if I'm not wrong, in Feb. Now, we just hope that the history doesn't repeat. The 4-year history doesn't repeat, and you don't have a lower level.
Great. Feb wasn't that great.
But still, we had the high.
I think the good chances Treasuries usually close books in March, and hence the profit or taking money off the table. Well, we don't even know what happened before 4 years. These markets were not as deep as they were, and we probably didn't even care too much. There was a very small portion of equity that probably found its way in a treasury. So one reason you see then the March effect is year-end. Treasuries do take some profits off the table, and we've gained about 3 months 10% in the last 3 months. So let's not forget that. While Jan wasn't too strong, the months preceding that haven't actually been too bad. So we shouldn't be too disappointed, is all I'm saying. And we've talked about consolidation, we've talked about time correction extensively, and that could be playing out in this series. So it's going to be a difficult March, but nevertheless, we'll take you through all the stocks you want to watch out for this morning. Niraj mentioned how automakers will be in focus. So counters like TVS Motors, Bajaj Auto, Tata Motors, Maruti and Hero Honda will be counters to track on back of auto numbers. PV sales might be seeing a recovery in this month, and that could be the knight in shining armor for some of these auto stocks. Well, moving on from there, let's take a look at stocks that beyond auto counters will be in focus. Yesterday, healthcare providers got hit bad. Today, pharma companies are back in focus. You've got Biocon, you've got Aurobindo and Suven Pharmaceuticals for various reasons. Let's start with Biocon. They've signed a settlement and license agreement with Janssen Biotech. The agreement is to commercialize its BMAB 1200, which is a proposed biosimilar to Stellar. Well, apart from that, that's of course the good news. Stellar's revenues are close to $7 billion in the US, and this was in 2023. Along with this, that's of course the good news. In terms of negative news for that the markets may potentially react to is Biocon had a US FDA conducted their inspection. They've issued 4 observations under Form 483. These observations do not impact manufacturing and distribution of products. That's what has been confirmed, but the stock might react sentimentally to that news flow. Well, Aurobindo Pharma, that's the other one, where the US FDA conducted inspection. They inspected the injectable facility of Eugia SEZ. They have come out with 7 observations. The Unit 3 of the Pharma Specialties, which is a wholly owned subsidiary of Aurobindo Pharma, is where these inspections were conducted. They've restarted production, terminally sterilized product lines at this facility, but with those 7 observations, it'd be interesting to see what the markets feel about that. In some other acquisition news, you had Suven Pharma as well. They've concluded their merger with Cohance Life Sciences. The transaction, they've announced that merger. The conclusion of that will be over the next 12 to 15 months. Cohance shareholders are expected to get 11 shares of Suven for every 295 shares held up. This will be double-digit EPS accretive to Suven Pharma. So good news on it. We will be talking to the management and, of course, take you through the rationale, what this is going to do to its top line, synergies for the company, and, of course, the conclusion of the deal as well. So that's Suven Pharma for you, and Aurobindo and Biocon. So, guys, those are the 3 from the pharma pack that'll be active. But I know healthcare generally got hit really badly yesterday. So.
Yeah.
Just for Suven, I mean, just the fact that Advent's stake now becomes the way it is, right? 67% is a big deal. I mean, yes, on anticipated lines, but that's from 51 to 67. So Advent, such a large presence through Suven, is arguably a big thing for Suven as well. So could be a very interesting one to watch out for today.
Yeah, we'll be hearing from them ahead in the day, and that's going to be interesting. But just on the point of healthcare and programming reminder, we're going to be, breaking down with Narayana Hridale what the impact is for hospital stocks. You saw quite a tumble yesterday because of a Supreme Court order that says that there has to be sort of a limit in terms of the cost of procedures, which from the point of view of, the average citizen, all right, important, but you have to understand the other side of the story, that how these hospitals can continue to give quality and, of course, from a stock market perspective, profitability. So we'll be talking more about that. But solar stocks are the other one that I want to highlight. So we know that the Prime Minister had announced a scheme on, solar rooftops, and 1 crore households will be given these solar rooftops. Now, the modalities of that scheme have become clear. Yesterday, the cabinet has cleared it, which is an important step to actually, taking it forward. So I would keep an eye on a Borosil Renew, Avari, a whole host. Borosil more than anything else because actual sort of impact in terms of making those parts, that's important. So what has happened is that they have made it clear 75,000 crores odd is what they are going to spend. The government of India is going to spend to make it happen. And that always gives confidence to the market because then there's clarity of the scheme. There are details also out of subsidies which are going to go directly into people's accounts if they choose for this. Loans will be given. Collateral-free loans at 7%. So this is going to be actually a starting point because even if you're not in that first cut of people who are getting government subsidies, once this becomes a system which is in place, the potential upside for solar rooftops is really sky's the limit. So this is one I would watch. The other one is Star Cement. Just quick mention because cement has also been an interesting space, a lot of movement. But Star Cement has received an LOI, about 11% up in a month. Not bad compared to the broader market. It's received a letter of intent from Coal India. 3.12 lakh tons of coal per annum is what they will get. This fuel supply agreement is for 10 years. So Star Cement won. 197 Communications. So 2 pieces of news there. One, of course, is an NDTV Profit exclusive, and the other, just came out a few minutes ago. So the exclusive story that we have is that Paytm is likely to move their merchant accounts to Yes Bank, and UPI transactions will be moving to Axis Bank. But apart from that, also an announcement a short while ago that Paytm and Paytm banks are going to discontinue various inter-company agreements, and shareholders of Paytm Payments Bank will be simplifying the agreement, the shareholders agreement, to improve governance. Now, this is a stock which has had a wild swing down, of course, 33-34% in the month. Obviously, since exactly a month ago the news came up, but it has recovered from its lows. So we have to see what this plays out for them because clearly the books, in a sense, are being squared for Paytm Bank and those loose ends getting tied up. A lot more, but I'll come back to that after you're done, Niraj.
Yeah, no, so for 197 communications. The other piece is what NDTV Profit exclusive was yesterday, right? So that it will be interesting to see both of these things play out. So watch out for that one. Watch out for Dilip Buildcon. We have a management conversation coming in later today. But they've also received an order worth 1955 crores from NHAI. So that's the second one in terms of the stocks on my radar. In addition to, of course, healthcare. Remember, we've spoken so much about it. Also adding to the healthcare luster is the US Jan data, which has been so strong that almost all generic makers could actually see traction in the session today. So watch out for Dilip, aside of Pharma and Paytm, Dilip Buildcon. And a small stock, I don't know too much about this one, viewers, so be careful. But Think Inc. Pictures. Now, I had not heard about this name until I saw the bulk deals, and it's a P-note transaction. In SocGen's case, it might be a prop buying as well, but SocGen has bought about 837 shares, and BofA Securities Europe about 307,654 shares. It's a 275 crore market cap company. I do not know anything about it. I doubt too many people know much about it. The volumes are okay, and there's been significant buying happened yesterday. Let's see if the stock reacts. It'll be interesting to try and research a bit about this. But if it reacts, you should know why it is reacting. The reason is possibly this P-note buying that has happened, and significant 6 lakh shares bought for delivery. And that's very large for the stock of that size and that volumes. So keep an eye out for this one as well. There is more, but I'm sure you have more.
Just a quick one on Dilip Buildcon. We are going to talk to the managements. Of course, you'll find out more about that order win and the fact that they are going to be debt-free. For an infrastructure company to be debt-free in 2 years is something that's noteworthy. Just a quick mention on 2 IPOs, Exicom Telesystems. This, of course, closed for subscription yesterday. But talking about liquidity and talking about how flush opportunities or lack of opportunities in the market, this one was subscribed 129 times. So commendable amount of money still flowing into the IPO market, and that's obvious with the kind of subscription that some of these IPOs are getting. So just a quick word on that one. The portion of non-institutional investors was booked about 153 times, while QIB quota was booked 121 times. That is, of course, an IPO subscription that's closed, but Bharat Highways InvIT, this one's also been on the radar for a lot of investors. It's a great proxy if you're looking to play the infrastructure story in India. You can either do it through equities or through InvITs. This one also closes for subscription today. They're looking to raise 2,500 crores. They've already raised 827 crores through anchor investors, but that's the other one that I wanted to mention, guys.
Yeah, just a couple of stocks and areas you should look at. Adani Group stocks I wanted to mention because their Q3 for the year, the group has recorded has put out a record EBITDA growth, and there were notes on this as well yesterday talking about it. Standard disclosures, of course, but 63.6% has been the record EBITDA growth year on year in Q3 FY24 for the Adani Group, and this is driven by its core infra business. So this is one set of stocks that I would watch out for. Vedanta is the other one, a setback, and quite a crucial setback for it. And I'm picking up Vedanta because you had a very clear bull versus bear case a couple of days ago after their analyst call. Some brokerages felt a level of comfort in terms of debt reduction, etc. But the fact that the Supreme Court has dismissed Vedanta's plea to restart their Sterlite copper plant is definitely going to be seen as a negative. So that's one stock perhaps that you should track. Clutch of brokerage notes, but we will come back to those ahead in the show as well.
Yeah, I mean, the Citi on IT note is interesting. Tech Mahindra and Wipro, some downsides. Just before we go to editor's cut, I mean, there's also Gujarat Gas in, but the auto estimates and just the numbers are interesting before we go to editor's cut. Bajaj Auto and TVS Motors are expected to show growth of 21 and 22% respectively. So those are to be watched out for. So that's the first piece. There is strength in Ashok Leyland anticipated, about a 34% growth expected on a YOY basis. So watch out for that one. And for Tata Motors and M&M, their cars business will do very well, but CV business and tractor business respectively would disappoint. So keep an eye out for those combined numbers. But can't take focus away from the fact that arguably the biggest talking point of last evening was the GDP data. So What were the intricacies and what should you watch out for? That is the first piece that we'll talk on Editor's Cut. And of course, top of mind for everybody for the last few days has been Sebi and its verdict on small caps. Sajith has an exclusive out there. But Vishy, multiple ways, multiple news stories, none bigger than the GDP data.
Yeah. Niraj, so this 8.4% Q3 GDP, that sort of blew all discussions out of the water simply because it's just unexpectedly high. It's about 180 basis points higher than the highest estimate out there in the market.
Yeah.
You're seeing strong growth on the manufacturing side, mining, construction, all of these various sectors showing an improvement year on year. Of course, last year's numbers have been revised to much lower. So obviously there is some amount of base effect playing in. Having said that, the growth number is still sort of shocking, and that's where the people are coming from. What is more interesting is the GVA, the gross value added growth, which is a net of all these of basically indirect taxes. You're seeing, and subsidies, you're seeing that portion coming in at 6.5%, which is absolutely where the estimation has been. So then what is this gap between the GDP and the GVA? Well, essentially
taxes.
The taxes. So that's up about 6 quarter highs, 32% higher, the growth rate. That's obviously going to push up the headline GDP number. What is more interesting is also agri. I think the contraction, this is the first contraction in 5 years, not even during COVID did we have a contraction on the agri portfolio, agri side of the story. It also sort of ends this discussion whether rural economy is under stress or not. I mean, it's very clear it is under stress. There is a monsoon issue which has played out in the agri sort of growth. What the government seems to suggest is that there is improvement in monsoon coming in FY25. Receding El Nino, better sowing of crops, all of these things are going to sort of improve on the agri front. FY25 is going to look significantly stronger. The government is also pitching for a better sort of outlook from multilateral agencies, IMF, World Bank. All of them are much below RBI's 7% estimate for FY25. So, we need to see what exactly those multilateral agencies do. Of course, the government's job is to pitch for a higher rating. But that's where we are at this point in time.
Yeah. So, I mean, Vishy, the standout feature, obviously, the taxes uptick or the tax buoyancy is leading to this. Suffice to say, though, that one shouldn't extrapolate this to what will happen in the next 4 quarters.
Not a stable source of optimism.
Yeah. But very quickly, Sajid.
If I can come in here.
Very quickly.
Manufacturing growing at 10%, which is good. But consumption at 3.5%, which is bad.
Don't steal my thunder.
Yeah.
But don't steal my thunder.
But let me say that, if the consumption remains the same thing, then you're going to see a moderation in manufacturing because there will be a high supply coming into the market, and that would have.
Sorry, why?
Because manufacturing, there has to be a consumption, right?
A lot of manufacturing is export-driven any which ways, right?
No, we don't. We are not an export-driven country in that way.
A lot of manufacturing being set up export-driven, no, Vishy?
I mean, there's also but you have to also consider the fact that there are external uncertainties also. So your export story might look good on the services front.
No, my limited point being that manufacturing thus far has stayed strong despite consumption numbers staying low only.
So consumption numbers staying low. Yes, true. Having said that, you still have to worry about where the globe is going.
Most certainly.
Because that's something that even the government, for example, the CA held a briefing last evening, and he was very clear to point out that there are certain uncertainties and there are elections around the world. So you don't know how things are going to pan out, let's say in 6 months or so.
Most certainly. No, I mean, if you are one of the top 5 economies, you can't be isolated from what the world is doing. But thus far, I must say, it does look. So from a market's perspective, I just thought I'll quickly throw in a quick perspective before we get to the other piece. I mean, how would equity markets probably perceive Q3? I was thinking that equity markets have this reassurance that there has been strong growth now, not just for 1, 2, but the last 3 quarters at the very least, right? So that is one reassuring part. And the HSBC flash PMI data thus far is pointing towards decent activity at the start of Q4 FY24 or Q1 CY24 as the case may be. So is that some reassurance that while we've had a very strong last 3 quarters, maybe the start of this 4th quarter as well has not been too bad. So that is the other piece. But will markets think that the tax buoyancy that we've had thus far, which has led to the GDP uptick, will that moderate? I think the markets would firmly believe that that will be the case. So in some sense, there will be some tempering of optimism or enthusiasm by this GDP
the
data.
base effect will play out in the next year.
As well. But yeah, just the fact that taxes buoyancy has been so strong, and at some point of time, you've got to give way to it because it won't continue. And private consumption, which I was telling Sajid, don't steal my thunder, 3.5% really, something needs to happen there.
You have to also look at the fact that there's a core sector sort of slowdown that's coming in for January. I mean, at least that's 1 month worth of data. Yeah. The whole quarter, we still need to see how that plays out. But there are sectors that are actually contracting within the core 8 core sectors, and doesn't look that great for the Jan-March period.
Yeah, it doesn't.
7.6 will probably come because of Q4. So let's see what happens for FY24.
Just very quickly, and we have 30 seconds on this before we move to the next piece. But what I thought was, will markets worry about it? Specific sectors, electricity and other public utilities expanded 9% versus 10.5 QOQ, and construction 9.5 versus 13.5% QOQ. Maybe not that much of a worry because we know it was an exceptional quarter. Correct. Q2. A lot of spends happened then. This is seasonally also a weak quarter for electricity, etc. So maybe the markets will not read too badly.
Just to add,
20 seconds.
Thermal is not doing means that much, but renewable is what is driving the growth in energy growth.
Yeah. Well, thermal hopefully will pick up. We've spoken to the coal secchi, by the way, and I think that conversation will give some insights out there too. But so this is the GDP. 4 more minutes for the next piece, Sajid, and that is something that has been spoken about for the last 36 hours, at least, if not more. The Sebi caution. Now you have some exclusive details.
That's right. A stress test on a portfolio which is valued at 5.4 lakh crores. That's the headline. There are nearly 56 schemes within small and mid cap there, and the regulator wants a stress test on each and every scheme of that. It doesn't mean a risk-o-meter like a very high risk or low risk. They want to do a stress test on liquidity, or how liquidity will pan out if someone is going to sell today, or the volatility and redemption comes into play. And that parameters have to be brought in by AMFI so that they are constant for every scheme, so that investor can know that they can map across the schemes and see which is a scheme they want to go in. Today, investor doesn't know about these risks. Many of the small and mid-cap schemes have stocks which are highly volatile in that sense. The regulator wants a long-term investment in small and mid-cap stocks. There are 65,000 crores of new net inflows that happened in last 1 year. And that's, nearly, and there's an appreciation in the small and mid-cap by most of the small caps have doubled in last 1 year, right? So that needs to be brought in and put out on the websites of all the mutual fund schemes and AMFI in a manner which is understandable for every investor. It should not be jargons or formulas, but it should be in a way saying that if your portfolio, if market turns 10%, your portfolio redemption happens by 10%, what is the kind of impact that may happen on your NAV? And you need to be very clear to the investors that this is the potential risk in a small and mid-cap fund, and you invest accordingly. They are also looking at exit load making it a little more difficult, in the sense the returns will be much lower if you are a small term investor or small term investor basically. So if you're investing for 6 months or 1 year, the exit loads are going to be higher. If you're a long-term investor, it may not be there. But this dynamic thing, it wants the industry to bring in, rather than it's putting his hand and saying that, no, you have to bring in.
Sajid, sorry, 30 seconds before we wrap up. The piece that you mentioned about mutual funds having to mention that if there is a redemption by 10%.
I'm just giving a classic example. This is the parameters are not been set. It has to be set by AMFI. But it will be in those lines. The danger of impact on the portfolio because of a redemption.
Can I just ask a question? Yeah. Nothing comes out of this, let's say. Aren't you panicking the markets then by introducing all of these stress tests? If let's say nothing comes out of it, it's entirely possible that the industry is pretty strong and these stress tests don't really show any kind of issues.
We have 30 seconds for this.
We have been speaking to a lot of fund managers on portfolio manager, and many of them are small cap managers, and they have a stress test for the portfolio, and they say that it takes almost a month for them to exit a stock, and they have to do it in a very gradual manner so that it doesn't impact the stock or the price. So if that is the case here, then mutual funds also have to have that kind of stress test for the portfolio, because a lot of new I would say majority of the new investors who came in the last 1 year, they have come into the small and mid-cap company schemes. Basically.
Fair call. 43,000 crores total, and then that value has gotten enhanced. And just that, Vishy, even if it's a new thing, it may take time to digest in the first 1 month. Then it becomes a norm, and therefore people may not get so spooked by it. Who knows? But great insights, both of you. Thanks for that. And do let us know in the comments section, viewers, if you like the stuff that we're doing on Editor's Cut. It's a differentiated thing that we're trying to do almost every single day. We take a quick break. Up next, another differentiated thing. My colleague Agam Vakil joins in to speak about the derivative space and give you some option strategies that might help you make money. Stay tuned.
Welcome back. You're watching India Markets Open. Quick look at the implied open before we get to our F&O coverage and where we seem to be sort of heading this morning. So positive start, no firecrackers, but definitely up in the green. What are the F&O cues looking like as we begin the March series? Let me go across to Agam for more.
Right, well, a new series and a lot to keep an eye on, but not bereft of volatility because of the high WIX environment that we are in at the moment. Now, yesterday we did see marginal gains, but on an intraday basis, it was a relatively choppy one. We did see the Nifty's add about a 33% increase as far as open interest is concerned, but that is also on expected lines because we are moving into new series, and it's the same for the Bank Nifty, which did advance by around 0.3%. And nearly 34% added there as well. Now, yesterday was a day where we did see some amount of consolidation, though, of course, with some amount of choppiness coming through. But it was a 22,200 mark where we saw most amount of writing activity. And, of course, that also serves as a near-term resistance of sorts. But let's pull up the open interest distribution, and that'll give you an idea about how things are panning out there. So maximum open interest in calls stands at around 22,200. And that input stands at around 22,000. Though 22,000 is still a little bit of a pivot, I would reckon that we will likely see a little more support around 21,700, 21,800, at least based on the data that we are seeing as far as puts go. Of course, we are heading into another week, and it is going to be another volatile one. So keep an eye on a lot of these factors, especially given that option premiums tend to contract so much towards the end of the series that in fact also leads to considerable volatility. But finally coming down to stocks and those which have in fact seen a surge in open interest as we move into the new series. So we have Z Entertainment along with something like an ABFRL and MRF, which are under pressure, shorts coming in, and longs for Canara Bank and Chambal Fertilizer. So see, these are some of the stocks that we will be keeping an eye on. But what are our markets experts making of these cues? Well, let's get in Shivangi Sarda of Motilal Oswal, who's joining us on the show. Shivangi, good morning. Thanks for joining in. Your assessment on the benchmarks, how would you address them as we move into a new week?
Good morning. Thank you for having me. So we've seen that the rollover figures for both the indices have been quietly fair enough in line with their quarterly averages, but Bank Nifty has seen some sort of lower rollover as compared to the previous months. Now, talking about index-specific, Nifty, we've seen that there was good follow-up buying in the entire February series, and it kissed a lifetime high as well. The last week, we've seen that there was quite a lot of volatile swings and profit booking, but then overall, the support base is quite strong. So now we are, immediately expecting that the index should hold these zones for a good up move. Now talking about levels per se, index should hold and continue to move above 22,000 for an up move towards 22,222 and then 22,350 zones. Supports, on the other hand, are placed at 21,900 and 21,750 levels. Now, talking about Bank Nifty, we've seen that the index was underperforming. It continues to do so, and it was followed by a pause in the second half of the session. But then overall, the index has contributed in this series after a lackluster of quite a lot of series. It respected its previous series low as well. So overall, we are expecting the banking index to pick up momentum. Short covering was seen in the series so far, with the open interest reduction of 30% of the shorts. So overall, we are, indicating that there should be some sort of strength over here for the index to move as well, because overall, we've seen only the IT pack has been supporting. So levels per se, immediate basis, we are looking at Bank Nifty to hold above 46,250 for a bounce towards 46,500 and then 46,750 levels. Whereas support can be seen at 45,750 level.
So those are levels to watch out for as far as the Nifty and the Bank Nifty go. But Shivangi, what about trading ideas this morning?
Trading ideas, I'm looking at Tata Consumer. This is the first pick on radar. The stock is looking quite positive with good amount of rollover over here as well in the previous series. Overall, we've seen that the consumption space stocks are picking up, from their lower zones, and overall, week-on-week basis, this stock has, performed from its support zones. So we are expecting a good up move over here. Now, one could actually expect this stock to go up and, initiate a bull call spread over here, which involves buying the 1200 call and selling the 1260 call at a net cost of around 15 to 18 points with a maximum reward of around 42 points. Now, the second pick on my radar is Siemens. We've seen a lot of action in the cement space as well. In fact, there is a lot of tailwind from the sector. Month-on-month basis, the stock has given a breakout and holding above its previous hurdle zones, which is now becoming its support levels, which is about 4,000 levels positionally. So overall, we've seen that this stock has continuously moved up with consistent buying at any small decline. And one can, initiate a bull call spread over here as well by buying 4,700 call and selling 4,900 call at a net cost of around 65 points with a maximum reward of 135 points.
Okay, so, two bull call spreads coming in from Shivangi. And the first one is on Tata Consumer Products, where you are, in fact, buying, a call and then, in fact, going ahead and selling a call. It's a very similar strategy for Siemens as well, where you are limiting your downside risk. Of course, you're limiting your reward as well, but the risk to reward stands at roughly around 1:3 in both cases. Shivangi, on that note, thank you so much for joining us and taking us through your views and also providing us a handful of trading ideas. And with that, it is back to you, Samina.
Thank you, Agam. Those, of course, trading strategies for the day. Agam also highlighting the F&O picture as we go into a brand new series this morning. Implied Nifty, like we said, is indicating to a slightly higher start, so it's actually not looking too bad in terms of trade. This comes in after a late recovery that D Street saw yesterday, after a big sell-off that was seen the day before that. A start about 22,200 is what we're looking at in early trade this morning. Well, lots of stocks that will be in focus this morning, with CG Power topping that list. They've signed a JV to build and operate an outsourced semiconductor facility in India. Mika is standing by with more details on that. Mika, what do we have? What's the news on CG Power this morning?
Yes, so it's a management equipment and solutions provider. Now, CG Power, along with a Japan-based semiconductor solution power called Renesas Electronics and Stars Microelectronics, which is a Thailand-based OSAT provider, are going to come and join hands for a joint venture to build a semiconductor facility in Gujarat. This is a part of the 3 semiconductor units that the government, approved yesterday, which has an aggregate investment of 1.25 lakh crores. Now, the JV has been signed to build a outsourced semiconductor assembly and test facility in India. Now, CG will own 92.3% of the joint venture, whereas Renesas Electronics and Stars Microelectronics will hold 6.8% and 0.9% respectively. They will invest 7,600 crores over a period of 5 years, and the financing will be done by a mix of subsidiaries, equity, and potential bank borrowings if required. The manufacturer facility will be set up in Gujarat and will have the capacity will ramp up to 15 million units per day. They'll manufacture various legacy packages and advanced packages that will cater to industries like automotive, consumer industry, and 5G. And that's what we have on CG Power as of now.
All right, thank you for that, Mika, with that story on CG Power. In any case, semiconductor is becoming a very, very exciting space. You had, presentation and a bit of news from Ashwini Vaishnav. He's a Union Minister for IT as well, talking about how the semiconductor plan for India is now kicking off. Of course, the Tatas with that big investment there. So we should actually be, looking at a detailed sort of deep dive on what companies can bring you the best value in terms of their semiconductor forays. But meanwhile, Kush Bora is with us. He's founder of kushbora.com. Kush, very good morning to you. And, great to have you on the show. So, new month, new season. I mean, Feb has not been bad, but it has been rocky for sure. How are you seeing the index right now, the Nifty and the Bank Nifty pair through the day today? A lot of news coming in. You think the small mid-cap sort of pain has been digested?
Hi, Tamanna. First, a very good morning. Well, it would seem so, at least on the mid-cap and the small-cap front. However, my suggestion would be, as we've advised our clients as well in our advisory service, is to gradually shift towards large-cap. I mean, this year we've seen a lot of volatility. Interestingly, if I can take a minute or two to explain about, what's happened in the mid-cap space, at least from the technical standpoint. there's something called RSI divergence. Now, we've not seen such a big RSI divergence, which is for three peaks, which means for three consecutive times, the mid cap and the small cap indices have made newer highs, but the RSI hasn't really caught up. So I think some profit taking is inevitable rather. Then there is also the fact that there will be some pockets that will continue to do well in the mid cap and the small cap names. But I think on the whole, I think a gradual shift towards large caps, is warranted in the portfolios. Now, as far as Nifty goes, it's been all over the place. But if you look at it from a slightly broad, standpoint, 21,800 and 22,200, that's been the broad range, and we're still within that range. So as long as that range is maintained, in fact, if I can push it a little lower, 21,600 also, that will be my buying zone. Somewhere close to 21,800 and 22,300 again, and 22,500 are the targets that we'll be looking at. Bank Nifty, not so encouraging, barely managed to hold on to its 20-day moving average. But until it takes out the 50-day moving average, which is close to the 46,800 kind of zone, I'll not be a big buyer in Bank Nifty, perhaps even consider some short at higher levels. But Nifty looks like a buy. And from mid cap and small cap, a shift towards large caps, is something that, the viewer should look at, at least for the year.
Then I have to ask you that follow-up. Okay, you're saying shift from the mid-cap and small caps to the large caps, at least for the year. So which ones then, Kush? What's topping your list?
Well, if you just talk sectors, then I think the capital goods sector is one area where we could perhaps see some sort of an uptick. The finance space is something that could see an uptick. So these are a couple of names. I think the recent names like PSU banks or the railway basket. I'm not saying that they've run their course. Of course, there is still some steam left, but I think we'll have to get a lot more picky, in these spaces, in these names, in the PSC space. We'll have to get a lot more picky.
Stock specific, Kush. We're looking for stock specific from you and what's happening on the charts.
So the couple of stocks that I have on my radar, are Concor and HFCL. These are the two stocks that I have on my radar from a trading perspective and also from an investment perspective from, as I said, 3 to 6 months kind of a horizon. So Concor is something that, traders can consider, and HFCL also. Both the stocks have seen a fair degree of rebound. So I think for a target of 995 and 1010 and a stop loss of 955 on Concor, and HFCL 111 and 114 are the targets, and 105 would be the near-term stop loss.
Quick follow-up from last week when we spoke to you. It was, I think, Geo Financials was a recommendation you had. We saw a big up move on the counter. It's cooled off over the last day or two, but still, I think, looking strong in the charts, right? At 310, Geo still on your buy list for a trade?
Oh, absolutely. In fact, I think, I don't know what the joke was, but, when the target 2 was hit and I said, let's hold this for an investment target of 350, it touched a high of 347 or 348 on the very same day. That was the exuberance that was, playing out. Now it's cooled off a little. It's again come back to, those buying territories. So I think buy on dips, the strategy that we talk about, it's the dip that the stock has provided and very much, on our buying list. In fact, this drop has made it a little more attractive for us. So again, with a target of 335 and 350, Geo Financial continues to remain a buy. And from a trading perspective, a stop loss would come close to about 275, 280 kind of zones.
Dharmesh,
okay. Sorry, no, I just wanted to highlight one stock because I think it deserves some mention across the day band today, simply because not just because it's an individual stock which is doing it, but it's just it's astounding as to how this has happened. Agrotech Foods, the promoter entity, has decided to exit the business. They hold about 51% stake. We should get up Agrotech Foods on the charts. It was up on the screen. It was up about 3% in trade yesterday. The point is, while they have sold the entire stake to the PE investor, they have done it at a price of 515. Agrotech Foods. They have sold it at a price of 515, which is a 48% discount to the current market price. And the open offer for 26% stake further is happening at a price of 578, which is about a 40% discount to the prevailing market price. Suffice to say, nobody in their right mind would give or tender to this open offer. But the point being, if you are a minority investor who bought the stake yesterday, who's been holding the stock and is looking at a price of 1,000 right now, you very certainly are looking at a price much, much lower than the current market price over the course of the next few days. It's a bit of a no-brainer, really. And expect the stock to open lower. But the question really is, how is it that some actions like these are allowed to happen at some point of time? I think the regulator will come up, or hopefully does come up, and questions a transaction of this nature, because you can't simply sell out a stake at such a low price and leave the minority investor holding the bag in some sense. You could argue that the majority promoter has sold it at 515 and the open offer is happening at 578. So in some sense, it's higher than that price. But that's the promoter's choice.
In terms of regulation, does it stop them from getting the best price?
I mean, even if in black and white regulation this might be allowed, Tamanna, but it's just shocking that something like this happens and the minority investor who's got no inkling of something like this due to come
gets left holding the bag.
Exactly.
Yeah. No, so that's the point. Part of it is, of course, what you're allowed legally to do and not do, and the other part is corporate governance and how you want to conduct business, which is equitable to all.
Yeah, this is just shocking, and Agrotech Foods most certainly today will start off on a lower circuit. I would be really, really surprised if it doesn't. So let's wait and watch. It was up 3 or 4% yesterday because the announcement that came in at 315 was merely about the open offer, etc., etc. The pricing came out at 6 o'clock or thereabouts. Let's wait and watch what happens here. So yeah, just thought should bring it out that this is one stock that we'll keep on talking about during the course of the day, and we'll try and get in some experts who understand regulations very well to try and talk about this as well, but certainly will be in focus. Okay, Dharmesh Kant Johnson, he's head of equity research at Chola Sec. Dharmesh, just before we get to anything else, do you have a view here on something like this that has happened on Agrotech yesterday?
I absolutely agree with you. Well, absolutely this should be looked into, and such kind of activity should not be allowed.
Yeah, most certainly. Okay, Dharmesh, quick thoughts. Are you buying any economy-linked sectors on the back of the GDP data that has come out yesterday?
Yeah, good morning. No, Niraj. In fact, at higher levels, I would be a seller in this market. I do expect this market to consolidate for as far as time-wise correction is concerned. And GDP numbers was great, but if you look at the internals in the GVA, that was not great. But you have rightly pointed out, economy-led kind of sector stocks can be in action. But the problem here is the valuations are too rich. You can have a pop-up today in most of capital goods kind of a stock or construction infra-led, but that's a pop-up and it will be sold into. That is my reading of the market and the reading of the internals of the GDP.
Dharmesh, I just want to get your take on the solar play, and this is something we brought up in our trade setup as well. And I'm wondering if you think we will see some impact on the stocks today, where there is a clear outlay now from the government of 75,000 crore rupees for this scheme of rooftop solar panels in 1 crore household. So it's more than just talk right now. Do you see an impact? And if so, which of these renewable players do you think has the most upside?
Yeah, Tamanna, I mean, the best part about this government is whatever they talk about, they walk the talk and the execution also happens. So the 75,000 outlay was definitely will be deployed in the future. And the beneficiaries, as of now, to my mind, would be more of a BHEL, NTPC. NTPC has already announced a subsidiary where they would be focusing more on the solar panel and solar related equipment manufacturing, and that is where the bulk of this order flow will come into. And nonetheless, like SW Solar, Borosil Renewable, Sterling and Vinson, they all will also benefit because some part of that will come into play. But the problem with SW Solar or Borosil Renewable is that they have already skyrocketed. The valuations are way too rich for them. So from that, the best play to my mind is still NTPC followed by BHEL.
We've also got a few more stocks that will be in focus this morning. We've highlighted a few already, but some of these counters had already started with the reaction in trade yesterday. For example, the Adani Group names. We've also got Mahima, who's standing by with more on that, and then we'll take a technical and fundamental view too. Mahima, over to you now. What do you have on your list this morning?
Right, Samina. So as you rightly mentioned, the Adani Group stocks will be in focus today because the Adani Group overall has reported an EBITDA growth of 63% year on year, and this is on the back of their core infrastructure platform that has generated approximately 66,200 EBITDA. Their airports operated have also seen a year-on-year growth of 23%. The domestic cargo handled have also seen a growth of 23% year on year, and the cements have seen a capacity increase of 15% this year, and the near-term debt maturities have also been fully funded. So the entire group of stocks will be on the watch out today. Then we also have MOIL, where the company has fixed or revised certain prices of the different grades of manganese ore, where the content of manganese ore over 44% will be continued as prevailing. However, the grade below 44% has been increased by 5%. So this will also be on a watch out today. And the third one being Chalet Hotels, where the company has acquired its partner's stake in Ayushi and Poonam Estates. The acquisition is for 315 crores. It's a 158 room hotel. Now this is important because Chalet Hotels is entering into the luxury segment of hotels, and this is the second hotel that it has acquired in terms of luxury and premium segment, and this will add approximately 40 crores to their revenue. So all of these stocks will be on the watch out today.
Right. Kush, quick thanks, Mahima, for that. Kush, very quickly, any trade on the Adani pack, Adani Enterprise, Adani Power, any of those counters that you are constructive on this morning? Some of them did quite well yesterday in trade itself.
We have on our radar, the stock hasn't really seen that big a dip, and it's held on to key support zones. So I think Adani Ports is something that I would pick as my trade for the day. 1340, and once that is taken out, 1375 are the levels that we can look at, and a stop loss comes in at about 1280 kind of a level, where there's the 20 DMA place. So Adani Ports.
Right. Thanks, Kush. And we'll just take a quick break. We'll come back and continue our conversation. The market is expected to open in a few minutes. It's going to be a positive start. We'll take a break. We'll come back and continue talking to both of you. So stay tuned.
All right, back with India Market Open right here on NDTV Profit. Among stocks that will have a big reaction this morning, aside of Agrotech Foods, which will start off lower, Welspun Enterprises could be in focus. I think Expert and Exchange release, they've probably gotten a very large order, northwards of 4,000 crores. We'll try and get the management as well, but that's one stock. Welspun Enterprises will come up on your screen. That's one stock that could be in focus as well. Could be an interesting one. Dharmesh, coming on something like this, a 4,000 crore order, presumably, for a company of this size, what would it mean? Because orders are still coming in thick and fast for a clutch of the companies in this sector.
Niraj, there's a question to me.
Yes, Dharmesh.
Yeah, definitely orders are trickling in, and both from the private space and as far as government infrastructure system, that is also happening. So that is the catch point. I mean, the business, there's nothing wrong with all these sector businesses as far as they are concerned. Business is growing as usual. The only point is the valuation metrics where things are heated up. So that's the only concern out there. And that is why, I mean, for the timing, we are choosing to stay away from any investment bets.
Okay. Well, watch out for Wellspin. Could be an interesting one. Kush, have you looked at the charts recently for this one?
Well, only when you started the conversation, but here too, nothing encouraging.
Okay.
305 is a strong support zone, but perhaps because of the news, there could be an uptick, but nothing really too big on the chart.
Yeah, well, 4,000 crores. It's an MLD water treatment plant at Bhandup in Mumbai. It's design, build and operate a 200 MLD water treatment plant. So watch out for this one. Could be interesting. The water space from an ion exchange to multiple other companies are getting some fairly large orders. So could be interesting as well. The other space, of course, and we are minutes away from the pre-open session, is IT. And IT yesterday had a bit of a pullback. Now Citi's come out with a note today, and amongst everything else, they've laid out their targets, especially for Wipro and Tech Mahindra, to be about 9-10% lower than the current market price. They are neutral on Infi, negative on the others. So this is the kind of downside that they see on LTI, Tech Mahindra and Wipro. Kush, up one day, down the next, down yesterday, IT, especially Tech Mahindra and Wipro. Anything on the charts?
Well, Tech Mahindra is a very clear avoid, has been for a while now. The rallies have not really been as sustainable. For me, the surprise here is Wipro, because after a while, this was showing some strength. I do continue to believe that, there will be some buying that, that will come in at slightly, lower levels, or perhaps from here on as well. So Wipro, I'm still constructive on. Tech Mahindra is a very clear avoid, and as I said, it has been for a while.
That's the call coming in on some of those counters. Dharmesh, you want to come in with stocks that you like? Fundamentally, anything that's looking good to you? And I know it's not a strategic buy call that we're looking for, something more tactical in nature. So maybe from a 1 to 3 month, perspective.
I think if I have to stick my neck out, private banking space looks still very attractive to me, because one fact being, a couple of stocks have not moved up in spite of very good set of numbers, and the case in point being IndusInd Bank and ICICI Bank. So Q3 numbers were actually good for both of these banking companies. But at the same time, the price action has not been that great compared to, say, if a public sector banking space is there. So this is one area where I am looking for from a trading perspective, as you said, 3 months. So ICICI Indian Banks does merit a case, along with public sector banking plays like Canara Bank and a Bank of Baroda. So weightage would be ICICI and IndusInd first.
Dharmesh, right now the mood, the narrative, the conversation is about whether we will see a bit of continued pain in mid-cap and small-cap stocks, especially considering the Sebi direction as mutual fund companies figure out what they want to do. If we see opportunities or cracks here, is there anything on your radar from this space? And before you joined, we were talking to Kush about how perhaps, at least for the next few months, the focus should be on large caps. Do you have that view as well?
Yeah, definitely. This is more of a technical and regulatory kind of bottleneck which can come into play, or a hurdle or break which can come into play. But if you look at the numbers of Q3, we did an analysis of top 500 market cap companies. It was all about operating leverage and operating margin play. Top line has not grown to that extent. It's at best it has grown to 12 to 14%. And if you look beyond 200 market cap companies, 201 to 500, it's a very dismal set of numbers. The aggregate PAT has grown only by 3%. And that is where the concern has been in the entire, mid to small cap segment. Few pockets of mid cap from 51 to 200 kind of a market cap rank wise, if you look at it. So only 25% of that basket has led to this 36-37% kind of a PAT growth. That too based on the operating profit pay. So I totally agree with even Kush's analysis that there would be some time correction and some, these companies have to come out with a top-line growth to justify the valuations where they are sitting at. So as an overall basket, will definitely come in for time-bound correction, if not a price correction. Price correction, some of it has taken, some more leg may still be there. But large caps does look attractive, and there I think private sector banking space looks more attractive to me compared to others.
Pick, Dharmesh, banking space, top pick.
I just said, I mean, a couple of minutes back, ICICI Bank and IndusInd Bank is the top pick out there.
All right, so ICICI Bank and IndusInd Bank. All right, another segment of stocks that has been in the news are hospital counters, which is because of a Supreme Court observation and actually a deadline that they've given the central government, that the center and the state have to come together for prescribed payments or prescribed costs of procedures and operations. And if they don't really come back with a solution, then within a month, the Supreme Court says it will implement the central government health services guidelines. Now, this was seen as quite negatively for a clutch of hospital stocks. What we're trying to understand today is, can this really happen? What would be the impact on profitability for some of these companies? There's a Jefferies note also today saying that it's unlikely anything will happen very soon. But to get a sense of it, I'm joined now by Viren Shetty. He's Executive Vice Chairman of Narayana Health. Viren, very good morning. Great to have you back on NDTV Profit. Just to understand the issue, now at the heart of it is a PIL that says, why is there such a disparity in prices between government hospitals and private hospitals? And they give an example of cataract operations, for example, that cost 10,000 in a government hospital, anywhere between 30,000 to over a lakh in a private hospital. So let's start with that core issue. Why is there a disparity, and do you see these Supreme Court observations as a large negative right now?
Yeah. So the price disparity between the government hospital and a private hospital is that in the government hospital,
I think it's hung. I think we just lost the feed with Viren Shetty. We'll try and get that going. The interesting thing is, guys, that Jefferies puts out a note today and says that such instances, multiple such instances have happened in the past, and we use these these corrections as they happen as a buying opportunity because the overall business model stays the same.
Absolutely. Viren is back with us. Viren, just want to do an audio check there. Can you hear us clearly?
Yeah.
Yeah, all right. So let's start that point from the beginning because, you froze in the middle. Yes, go ahead.
Yeah, healthcare is free essentially in the government hospital. It shouldn't cost anything because all the costs are paid for, and it's paid for from our tax money. The land is free, infrastructure is free, all the costs are fixed, the salaries are paid for. So the cost really is not the embedded cost. And if you go to a private hospital, the costs are borne by the institution and it is passed on to the customers. And so that's why you see a price difference. But I would say there is a larger point, for sure, that a lot of people are not able to bear the cost of paying for healthcare out of pocket. And in some cases, they may be paying a lot, but people always have choice. There are a range of options they can go for. There are large hospitals, smaller hospitals, organized, unorganized, non-profit, trust, large corporate hospitals. So there is in a market economy a tremendous amount of choice that a lot of customers have, which they can exercise. Now, granted, that is only for the big cities, not the small towns. There needs to be a wider expansion of healthcare, but that will naturally happen as the economy progresses.
Coming back to the point of, what impact do you expect from what the Supreme Court has said? If they've given a month's timeline and have urged center and state to come together, do you think in a month you will be seeing some regulatory news which could be negative for you?
Maybe. See, the truth also is that what is the nature of the thing that they want? Does the government really want a uniform price for every single procedure across every single hospital, no matter the quality, no matter the infrastructure? In which case, yes, there will be a tremendous impact. This will be impact on the scale of what this country went through in the 50s, 60s, and 70s, where the price of everything was fixed. So what happened is the supply naturally came down. There has been an explosion in private healthcare because there's an unmet market need. And there is, in our country, an ability for people to get healthcare at the price that they can afford for most people, not for everyone. So if you disincentivize investing in quality, investing in high-end infrastructure, then you won't see any more of that anymore. So it will be a massive impact if you fix a common price for everything, no matter what.
What the CGHS prices are right now, because the Supreme Court has identified a specific sort of yardstick to make a decision. So give us a sense, are these massively lower than your current prices for standard procedures, for example?
See, the CTHS prices were fixed in 2014, and even by 2014 standards, they were much lesser than what was being paid. It is currently what the government pays for their own employees, and their own employees get a very good deal in most hospitals, but it is not what the common man has to bear. The price difference can be as little as 20% from what it actually costs to 60% of what it actually costs. So it's not a realistic assumption, nor will the amount of effort that it will take to do a rational pricing study to actually find out what the embedded cost of each procedure is. That is an enormous exercise. Now you can do that, or you can just say, look, let the market decide. Let's not, as a government, sit around and fix what the price of every little thing should be, because we're not in a communist type economy anymore.
Just the last, question for you over here, Viren. And what kind of a role has the growth of insurance or medical insurance had in terms of comfort of pricing? Is it becoming more comfortable to price higher because when given the coverage of insurance, people will prefer a private hospital, a better quality one, even if it's more expensive?
See, insurance is the only way a developing country like ours will be able to bear the cost of healthcare. It is unnatural to expect a normal person to pay upfront for the cost of their car. No one pays upfront other than the top 0.1% for the cost of their house. They pay through loans, through EMI, and they stagger out the payments over a couple of years. So healthcare costs are the same throughout the world, and there's no reason why in India it would not be the same. So healthcare affordability is it's very poor right now because people are paying everything upfront. But as more and more insurance starts to go up, as companies like ours start getting into insurance, then you realize that actually the costs are not this one big lump sum that you bear upfront, but a small premium that you pay over the years. And that is something that becomes much more affordable. So this problem will address itself. The observations of the Supreme Court are valid in total. They're valid in that people are finding it quite unaffordable. But the solution does not match the problem that they're trying to solve.
Perhaps increase insurance coverage. Thank you so much, Viren, for coming in and explaining that entire issue to us. Pre-open rates have closed, and I'm spotting Hindalco as one of the top gainers. We're looking like we're in for a positive start.
Positive start, and when you look at the BSE 500, the stock that stands out really is CG Power, up 9%. This is after the 4% uptick yesterday, as the news gets digested about the plan that they would actually 14%. I stand corrected. On the NSE, it's 14%. On the BSE, it's about 9%. So very strong start to this one. Clearly, it's eclipsed some of the targets that experts might have on the charts as well. But I'm inclined to ask Kush Bora about this nevertheless. By the way, the other one is Bajaj Auto on your screen. The total sales are actually 25%, so higher than the 22% that was anticipated. So watch out for Bajaj Auto as well. The pre-open rates have settled, then the numbers have come out, and the numbers are better. So maybe expect a bit of spurt in Bajaj Auto as well. But Kush, very quickly, CG Power.
Well, I think we're seeing what we call an emotional gap up here. I think, take some money, off the table. Fresh entry should be avoided. And, we'll look at buy on dips kind of a setup here. Although it's broken a few resistance zones, but as I said, it's already factoring in most of the news that's coming.
Gurmeet Chadda, Managing Partner and CEO of Complete Circle with us as well. Gurmeet, good having you. Thanks for taking the time out. What did you make of this announcement around this whole 3 semiconductors and a company like CG Power qualifying for it? It's clearly showing in the way there is enthusiasm around this. But have you tried to analyze what it could mean for this business as well?
Niraj, hi. Good to be on your show.
Thank you.
I think it's as he rightly said, that could be a bit of a reaction to the semiconductor news which has come in. But, the company has seen significant re-rating post-ownership change. Now, they have 2 businesses, the traditional businesses, distribution and manufacturing of, transformers and other equipments. And then they are into the control systems and communication systems. The stock at around 500 right now probably trades at maybe 65 times FY25 EPS. So I think that's a reaction to it. But semiconductor, we have seen is one space where the market really likes. We've seen what NVIDIA has done. I'm not comparing at all. And you take years to build that kind of capabilities. So it could be a reaction to that news, but valuations are pretty expensive. Otherwise, bulk of the re-rating because of the promoter as well as the this news probably, in my view, is in the price.
Right, we've got 2 minutes to go, and it looks like we're gearing up for a pretty strong start, at least in the first few minutes. Gurmeet, very broadly on the markets, a quick word. There was an up and down with that advisory coming in from the Sebi. The markets got freaked, made sense of it, and finally did a little bit of a recovery in the second half yesterday. But largely speaking, advisors keep telling you to rebalance your portfolio. Now the regulator's telling you, I'd imagine. So what really is the big deal to get spooked?
I think market has some memory of 2017-18. 2017, if you recollect, small mid caps had a stellar run, and there was some recategorization Sebi and MP did on small, mid, and large caps, and that led to some massive churn. So while the headline index did not show much pain, the indices fell like 20-25%. 2018 was very brutal for this space. And it has run up. It has run up almost. The index is up 65%. And mind you, now it's a much bigger category. So the small cap AUM is 3 lakh crores. That's almost equal to large cap funds. And bulk of the flows, more than 50% of the flows are coming in this category. People always have recency bias. And I think regulator is right in terms of they're not really trying to saying that there is systemic risk, but they want to prevent. So what happens is that a lot of these small cap funds, one of the fund is now 50,000 crores. You hold about 200 stocks and you keep getting flows and you keep buying what you like. At some stage, if the redemption happens, the same liquidity then becomes a bit of a challenge. So I think what will happen is if you see some of these small mid-cap funds, they have raised some cash levels because Sebi is also asking you to do not only restricting flows, but do some stress test. So in the short term, they will raise a little bit of cash levels, also do some rotation in some illiquid counters, which could lead to some interim volatility. But I think this is a timely step to prevent a larger magnitude kind of a things. If let's say some external event, like a war, like anything, any credit event happen, the unwinding can be really quick.
Got it. Gurmeet, stay on. So much more to talk about. Kush, 20 seconds left. If I had to ask you to give one top call for the day today, which one would that be?
Concor.
Concor is your top call. It's a day trade or a short-term positional trade, you're saying?
It's a short-term positional trade. 995, 1010 are the targets and 955 is the stop loss.
Okay, guys. So Concor, 1010 is the target for that one, 995 or 1010. And I heard 950 as the stop loss. So watch out for Concor in the session today. Bring up the markets this Friday morning and let's see how we're starting off. Should be in the green. Let's see how much. Well, 86 points, not bad. 22,069 for the Nifty 50. Sensex about the same levels, about actually, no, not as much. So there is a disparity between the Sensex and the Nifty. We'll get the components of the Nifty to try and figure out what's causing this. Nifty, okay, we're getting some iffy rates, but this is the Nifty contribution. HDFC Bank, L&T, no. I think these rates have stalled a little bit. Let's just try and refresh this. Let's say if we can get the heat map up on the screen, because these rates aren't quite moving. But yes, Hindalco about 2.81%. Guys, I think we have a bit of an issue with the rates because the rates aren't quite moving. However, suffice to say that Hindalco is very likely started off well. And suffice to say that not too many losers in the session today. So I think that's to be kept in mind. Let's try the single stock charts and see if we are getting some rates there, because these rates aren't moving. Some technical difficulty and can happen. Maybe pull up Hindalco individually and see if we're getting Hindalco or a BPCL or a Cipla and just try and see if we're getting those stocks individually. Maybe not. I think we'll just try and get... Guys, are you spotting anything on the charts yourself?
The breadth looks as good as what we were showing a few seconds ago, but quickly take you through the big movers this morning. It is Hindalco and Tata Steel topping the list. It's not just Hindalco. You've got both those counters ticking in gains of over 2%. Bajaj Auto on back of those numbers for the month are looking good. More importantly, the counter went ex-buyback yesterday, on back of which it saw some pressure in trade. So a little recovery is what is playing out in trade this morning. 2% high on that one. Tata Consumer looks good. Auto as a pack really is having a pretty pleasant morning. Hero MotoCorp too, not too far behind. Aisha, Tech Mahindra, HDFC Bank are some of your other gainers. A handful of losers. We've only got 5 stocks that are seeing pressure on the Nifty 50. Of the Nifty 50, 45 counters are trading firm. The 5 that are looking weaker this morning is Apollo Hospitals, Sun Pharma, Nestle India, Infi and Cipla, both that are trading flat. So all in all, it's a good start. The Nifty is holding itself together, 136 point up move on the index, 610. 0.2% gain for now. Tamanna, broader markets?
Yeah, absolutely. You are seeing broader markets actually not doing too badly this morning either. And, here, let me just go across to Gurmeet very quickly for his view of what kind of a mood that we will see. Gurmeet, we're just beginning the new month and absolutely, we spoke about a bit of that uncertainty yesterday that has settled. But remember that the focus towards large caps in this year was widely expected. And do you think that that's what the market will reward now?
I think broadly categorizing, large, mid, small is restricting yourself. And I've said this, so, the largest depository today is a mid cap. The largest ethanol play is probably a mix of small and mid cap. The largest tile maker in the country is a mid cap. So I think it's just that a lot of the categories in India are evolving and, continue to grow in size. Look at the Reliance Disney deal. Netflix alone market cap is $260 billion. And we had this entire deal happening at 70,000 crores, right? At about $10 billion. So I think a lot of the categories will go, and it's important to be with leaders and where valuations are more reasonable. I think interest rates will take some time to come off. Yesterday, the core PCE inflation came at the lowest since 2021. So I think that's one sign of relief. And pending home sales in US is also, showing signs of slowdown. So I think at some point of time, rate cuts will happen, maybe May, June. And that's the time when, one part of the index, which is not doing well, which is financials, will slightly coming back. The rate sensitives will make a comeback. Remember, there were no takers of IT 6 months back when Infy was 1,200 and TCS was 3,000 and HCL was 1,100. Right now, there are not much takers for a lot of private banks right now. I think financials will make a comeback. Let liquidity ease. I think the 1-year T-bill, if you see, I saw yesterday, is 7.1 and the 10-year GSEC is it's around 7.05. So, and liquidity is really tight. A lot of this will start changing post-advanced tax and as we enter into April and election season. And I think financials, in my view, can make a bit of a comeback and rate sensitives. I don't want to be too, clubbing myself, with large, mid and small cap kind of categorization.
Do you think HDFC could take lead then in that case?
No, I wish and hope, personally been holding it for a very long time. So it's frustrating. I think what I am a little disappointed is that the management hasn't really come out with a more concrete guidance. I think there's also the leadership change. A lot of things happened. RBI had some actions on them. The credit card businesses had some issues. I think one issue which has not been highlighted enough in HDFC is the branch level attrition. They've been adding 1,200 odd branches year after year. A lot of the branches take 2-3 years to break even. So as they mobilize deposit and they can address, that's like 33% at a branch level. And I think that attrition is also leading to some kind of issue, even in the deposit mobilization and CASA. I think if they can address that more effectively, I think it'll come back. And, this problem is temporary in my view. They've taken 6 lakh crore kind of a mortgage book. There will be pressure on CD and liquidity coverage ratio. I think with maybe 1 or 2 quarters, this should ebb. And 14 times earnings, I think you don't get this kind of a franchisee at that valuations.
Guys, what's impressed me so much in the last few days, and yesterday when I took notice of that, Zomato. I mean, if you just look at the 3-year chart or a 4-year chart of Zomato, from 169.5 or 170, the stock fell down all the way to 45 rupees. It's recovered all of that ground, is at 171. You, I, Samina, I'm guessing all of us use that or Swiggy, either of the two. I'm not being saying that we use one or the other, but everybody uses these apps now.
To have an IPO by the end of the year.
And we're not even talking about Blinkit as yet and the contribution, what was considered to be a drag. As per a lot of my friends who've got kids, maybe the two of you could be saying this out as well, maybe, is Blinkit is one of the top apps for all the youngsters who use Blinkit to order last minute groceries.
Luckily, our kids are not youngsters who are accessing Blinkit yet.
We are using it. And
you are, okay, I'm not using Blinkit,
youngsters.
sorry.
No, I'm taking offense at all the statements. No, so Blinkit is fab, but what's happened with Zomato, I don't know if you all have noticed on the app, now you can book tickets on it. So they have moved into events as well. It's a beta rollout, I think, in some cities. They've not really quite announced it, but they've gone into Book My Show territory as well. So there are extensions, I suppose, that are coming in, and that may have
becomes a super app at some point
in time.
And
it's a striking contrast from what this was. 2 years ago, every single person in the street had written off Zomato.
Exactly the point.
So it's a turnaround of sorts.
And we're not talking about Blinkit, I repeat. We're still not talking about Blinkit as yet.
Just talk.
And what it could do.
Yeah, just just a quick mention, Suvain, I don't know whether we talked about this one, but have you guys seen the up move on that deal? It's 10% on Suvain is what we have this morning. So that's pretty much what I wanted to highlight. But I think it'd be nice to get Gurmeet on this. Niraj, you want to pick that up?
No, I mean, but the same thing. Gurmeet, any thoughts on Zomato?
Yeah, I think pretty constructive. I think what helped them was the guidance that even Blinkit will turn positive in first quarter of FY25. If you see, Niraj, last quarter, which is what led to this surge, the delivery in Blinkit was 27% quarter on quarter. Obviously, that festive season, the coin deliveries, the other stuff which Blinkit was used of, nobody thought of that. And Zomato, the growth was 10% Q and Q. Thirdly, they have really worked on the food contribution margin. It's jumped to more than 7% now. And Blinkit continues to show progress. Remember, they have this almost 3 lakh fleet of own riders, and this can be used to very effectively for, tomorrow logistics or, and plus kind of data they have in terms of analyzing how much biryani I have in a week and how much the South Indian somebody has in a week, right? So I think a lot of that will happen. Also, the ad monetization on the platform, that's showing some progress. So I think it's all things coming together for them. My only risk is the take rate at 22-23% and ONDC causing any disruption due to that. One thing I noticed, and I don't know if you have noticed, as this could be a Delhi phenomena, that restaurants have started sending pamphlets saying that if you order directly with us, we'll give you more discount. And I think that's something they have to be careful about. These take rates of 23%, especially the listings, I think that is the only risk in my view, if they can address that.
No, it's a Bombay phenomenon too, by the way.
But
just
look at it. I missed what Gurmeet said.
With restaurants saying that order
directly through us.
Yeah. Okay, that is...
You cannot compete with the efficiency. That's the
Maybe
problem. And the interface, they've tried it before, restaurants versus Zomato.
More importantly, I need choices. I'm not going to Zomato because I know which restaurant I want to go to.
You want Zomato to help you decide.
In that sense. So, Gurmeet, that's a question, right? I mean, sure, restaurants will try to do that and, other factors, but Zomato gives you choices.
Absolutely. So that's why I said, the ONDC too small right now. Can it reduce the take rates? Number one. Number two, in my view, is the structural reasons which are supporting Zomato is we are cooking less as a nation. The average cooking time is down by 4 hours a week. And it's continued to go down as family becomes nuclear, as both partners work and, the new generation starts living more. We call them experience economy. They want to own less and avail more services.
Not good for health to cook less. Healthier to cook more at home. But I just want to quickly, Gurmeet, get your take on another couple of segments of the market. And you spoke earlier about how elections policy is going to, take uppermost mind space right now for the markets. And two things that have come just yesterday. One is the cabinet clearance on the solar rooftop scheme with a 75,000 crore outlay. You're seeing Borosil react in open trade as well. And the second is the semiconductor play, where obviously CG, because of its own foray, is up. Do you think that these are going to be the big themes to watch out for over the next few weeks?
I think energy overall will be a very big theme. Just look at the way most power companies have done, including PSUs. I think there's still a lot of value in NTPC and Power Grid. We need to add almost 200 gigawatts in the next 3 years to avoid an energy crisis, the way we have electrified and adopted energy, and that itself would probably entail huge demand. So even now the color of the power demand is also got diluted. Nobody's talking of thermal versus clean. NTPC has ordered almost 11 gigawatts of thermal power plants. That's work in progress for them. And there will be some, monetization as they list their renewable arm. Very good valuations. Power Grid, again, we probably will see orders worth 2 lakh crores only on transmission lines in the next 4 or 5 years. So there's a lot of visibility there. And there's one leg of re-rating has happened, but they still trade at 14, 15 times. Another leg can happen if they can show execution, catch up with the order. I think that's where markets will get more comfort. Also, the EV charging, the solar panel was so pretty constructive there. I think one part which I want to be a little counter-cyclical, is the agrarian and the rural economy. And I think closer to election, that will get a lot of fillip with more transfers, more benefits being given to farmers and the rural economy. So, some of the FMCG names which have not really done too well, except maybe Tata Consumer and Godrej. Some of the, the chemical names, so got to be a little counter-cyclical in my view. Some part of the portfolio. Chase momentum, that's fine, but be a little counter-cyclical as well.
Kush, couple of stocks you want to come in on. Suvain, it's up 10% as we see it in trade right now. Borosil is up 6.5%, and Dilip Bilcon is also up 3% on back of the order win. How are these three looking on the charts? Any intraday trades here?
So not on Suvain for sure. The stock was actually languishing, below its key averages, and today's just been a spike. Could well be a dead cat bounce. So for me, this is an exit opportunity. If I have any positions on this, I would rather exit. As far as Borosil goes, very similar story here. A slight rebound, but taking resistance at its 200-day moving average. So Borosil is also like a book profit kind of a setup right now. And as far as Dilip Buildcon goes, I think the space is doing well. The stock is a buy on dips for me. So this is one that I would add. So among the three, Dilip Buildcon's the only one that's looking strong. So with a stop loss of about 435, a positional target of 480, and then once that is taken out, 500 plus kind of levels. So Dilip Buildcon's the only one that's really standing out on the chart.
Okay, gentlemen, we'll leave it on that note. Thanks so much for taking the time out and being with us today and giving us your thoughts. Really appreciate your time this morning. Have a great weekend. Well, on the note that the markets are not doing all that bad. In fact, we're now trending and trading at the highest point of the day, led no doubt by Hindalco, but some of the others too. We'll take a very quick break, come back with more conversations. The management of Dilip Buildcon, which Kush Bora said looks the best on the charts, joins us on the other side. Stay tuned.
Welcome back. You're watching India Market Open. The markets are not doing too badly this Friday morning on the first day of the March series and the last day of the week. Well, one stock that's grabbing our attention this morning once again is the Bilcon. It's been fairly active in trade over the last couple of weeks on back of order wins and InvIT. Lots happening with this one. Like we did tell you, the stock's up about 2.5% on back of a 2,000 crore order win this morning. Let's not forget, we've been calling this the Bilcon 2.0. After about over 4 years, we did get a chance to talk to the management of Dilip Bilcon, where we began by asking about the company's business outlook, the quarter gone by, order wins, and more. So listen into what Rohan had to say as I caught up with him yesterday.
Today, during COVID, we obviously suffered a huge bunch of losses because our business model was around owning our own assets, having our own people, and building all the projects that we were doing on our own. During COVID, obviously, once we had people sitting idly on our sites, but we were still paying them their salaries, our equipment was sitting idle, we were still paying the EMIs. So all of them, caused huge losses to the company. Post which we decided that we need to rethink our business model and we need to kind of focus on being more asset light at the standalone level. So I think that's where the whole thought process started. So one of the things was we wanted to be asset light. Earlier, we used to invest around 500 to 700 crores of money every year in just buying new equipment. And we have a nice big asset bank, because of which we are able to function across 20 different states in India. So today, we're doing work in almost 8-9 different sectors, whether it's roads, bridges, tunnels, water supply, dam, irrigation projects, metro projects, airport projects, or mining. And all of these sectors, we do it with our own equipment and our own people. But when we were kind of thinking about, we need to now consolidate our gains. We need to build stronger from where we have. We took a hit on our chin, and now we need to kind of sort of take the next couple of years. We're focusing on our cash flows, reducing our debt. So that was the strategy. So number one, we stopped investing in new equipment, or almost only like replacement capex of 50-100 crores every year. Second thing that we did was we wanted to focus on building both short-term cash flows along with that long-term cash flow. For the long-term cash flows, we identified our asset businesses. One was the road asset business, which we had, where we were building these assets and selling them to to funds. And the second was the coal asset business that we had. So we decided that we need to keep some of these in-house and not monetize them as soon as they're completed. So in that regard, we are setting up our own InvIT for the road business along with an investor, Alpha Investments. So overall, that was the kind of strategy that focused on reducing debt, don't do new investments, and focus on finding a mix of long-term cash flows and short-term cash flows.
Wow, so you're obviously making it much sharper and operationally better. Let's start. We'll talk about the InvIT in a minute, but and monetizing those assets and creating the long-term cash flow. But let's talk about guidance. You've managed to do about 7-8% top-line growth. Margins are looking also fairly healthy. If we have to look ahead in the next couple of quarters out, what is the sort of revenue guidance could you share with us? And in terms of margins as well, this 12 to 12.5%, 13% is possible, or is there an upside risk on both revenue and margins?
So, in our sector, it would be very unwise to give quarterly guidance, because, when you're doing these large infrastructure projects, whenever we give out guidance, we usually give out guidance in terms of years. So this year we had guided at the start of this financial year, we had said that we will grow about 5 to 7%, and that's where we are kind of going to be at. So about 10,500 crores in terms of top line is what we are targeting. The EBITDA margins, you rightfully said, would be around that 12-13% kind of range that we had also indicated at the start of the year. The biggest thing that we had indicated at the start of the year was that we would reduce our debt from the net debt levels of about 2,300 odd crores or so we'll reduce it by 800 to 1,000 crores. In the first 9 months, we've already reduced about 500 crores. And we're very confident that we will reduce it by the numbers that we had indicated. So by the end of the year, we would have a net debt of 1,300 to 1,500 crores. That would translate to debt EBITDA of 1:1 times and a debt equity of 0.25 times. Now, going forward, the year after, if I were to give you rough estimates, we have only said we will grow around that same 5-7%. We are not chasing growth because growth with our business model came with a lot of capital investments. And because we are now focusing on cash flows, reducing that, so we are not looking at some massive growth. In fact, the growth will come from the bottom line. Now, again, next year, I could say that we are targeting about another 8 or 100 crores of debt reduction. So, which will bring down our debt reduction to, the year in, like when we look at FY26, we should be around, or like when we end FY25 rather, we would be somewhere in the range of 500 to 700 crores of net debt at an 11,000 crores or so of top line with a 13% kind of EBITDA that we've indicated. So that I should say would be the broad numbers.
You know, Rohan, I'm very intrigued to ask you because this is a tough business, and to be or aim to be debt-free is the goal, the objective itself is noteworthy. You've successfully reduced your debt significantly, like you indicated. Give me a sense of what are you undertaking to improve your debt levels? Have you, are you addressing your debtors quicker, cash flows improved? Are you doing an equity infusion? How have you managed to reduce debt, and how do you plan to do that and come down to being a net debt zero company?
So, a bunch of things that we've done. Like I said, reducing investments that we are making. So that frees up a bunch of cash, not making investments in equipment. And the equity investments that we have to make for our PPP projects are now kind of tied up with our deal with Alpha. So we are getting a whole bunch of cash flow from them as well for buying that 26% stake in the InvIT. And also, they're also investing in the company's warrants that we've issued to them. So in total, we've done a deal of about less than 2,000 crores with them. And that capital will keep coming over this year and the next couple of years. So that will be an additional kind of capital that will come and help us in reducing our debt. Then the internal cash flows are also pretty strong. All the different businesses are now doing well. In the last 2-3 years, COVID, like I mentioned, we had cost escalation because of, all those idle costs. And then there was also material costs which went through the roof. So all those things have caused, eventually for us, for our profitability to kind of erode. Now we're not seeing any kind of situation like that. The economic outlook for India, while it seems pretty good, globally the economic outlook is not good. So I don't think there should be a lot of inflation in terms of material pricing as well. So taking some comfort out of there, also because we've diversified our business fairly from different sectors. Earlier, we used to be almost 80-90% in the road business. Today, our road business constitutes only less than 40% of our total revenue. So I think all the different sectors where we have kind of deployed our assets, the cash flows coming from them, and then the cash flows coming from outside are all in total helping us achieve this goal.
Right. So for now, if I've got this right, Alpha Alternatives is invested in 18 road assets. Is that correct, Rohan?
They will eventually invest in 18 road assets. This year, we will put 8 assets into the InvIT. These are the assets that are completed. And over the course of the next 2 years, we're building another 10 more assets. The total AUM of these 18 assets, direct and equity total put together, would be somewhere in the range of 13 to 15,000 crores, the eventual valuation. So that would be the initial InvIT size that both of us are going. So about 6,000 crores of equity or so of equity value, where we will be owning 76%. Now, so 2 years down the line, when all of this is complete, when we have all the assets put in, it would give a free cash of 500 crores plus to DBL every year. So that would sort of be a big support to DBL besides its already EPC business.
Right.
So that is something.
Yeah. So, Rohan, you're clearly not buying any more equipment, like you said, and you're operationally being able to manage this efficiently right now. With that free cash flow that you indicated to us over the next 1 to 2 years, would that money be used for expansion? You also talked about going into different geographies, reducing concentration risk, and we've heard about the project wins in states like Goa as well. You want to talk to us about that a little bit more, and also what will be the end use of this free cash flow?
So, firstly, in the next 2 years, the most of the free cash flow is going just to reduce the debt.
Yeah.
Whatever is having, we're just making it a completely debt-free company at the standalone level. We will continue to take bets and debt on the consolidated basis, obviously, because all the asset business, the debt comes on the consolidated basis and on the SPV, specific SPV level. So we are comfortable doing that. So we'll continue doing. Besides that, we are already in 20 states, and the sectors that I mentioned earlier, we are looking at opportunities in all those sectors. So wherever we find there'll be an opportunity where it'll be a good place to deploy capital, we would definitely do that. I think so. But the next 2 years, most of the capital would kind of go to reduce that, besides the equity commitments that we already kind of have.
And what is your order pipeline looking like right now, Rohan? I mean, the biggest story in India right now, elections around the corner, is infrastructure. And the proxy to play the India infrastructure story is through companies like yourself. You want to give me a sense of, you did say that revenue growth is what we are aiming is in that 7 to 8% range. But conversations that are currently underway, order wins, how is that piece looking?
So in an election year, always the ordering is slow. If you look at historically, speaking, all the election years we've seen, a gross dip in ordering. But post-election, it picks up pretty healthily. If I talk about NHI alone, has floated about 1.5 lakh crores worth of orders that we are obviously looking at. But most of these would come out post-elections. We'll be pretty prepared for those biddings as well. Besides the road business, there is water, mining, metro, and like I said, all the other different things that we're kind of doing. So all those areas should give a good impetus. And as you also mentioned, that the government is very focused on building infrastructure. So I think they want to make sure that building long-term asset, which is very, very important for a growing country like ours, which has ambitions of the $5 trillion economy. So I think we're very confident that we will see a lot of orders coming in the next financial year as well. And currently, already we have visibility for the next 2 years, 21,000 crores of orders already in hand. And with our current run rate, 2 years of visibility is pretty much sorted.
Right. Very lastly, Rohan, we've talked about Dilip Bilkon 2.0, and you look at those valuations. Clearly, you're an investor favorite in this infrastructure space when compared to your peers. Next leg of growth, right? And I want to understand that. Of course, you're fixing the house. You fixed the house significantly already. Everything's going as planned. The two things that I'd lastly want to know is what keeps you awake at night when you think about Dilip Bilkon's growth, and where will the next leg of growth come from? You've got various verticals, various geographies, but anything else that we don't know and we should know?
So this is a very tough sector to be in, and all the different verticals that we've also gone. It's not a very easy job to build infrastructure in India because it's highly regulated. You have to coordinate with a lot of government agencies. So, the asset that people get to enjoy, they don't realize the pain and the sweat and the blood that goes behind it. It is, the biggest challenge that we also face when we're building any kind of infrastructure is actually managing stakeholders, getting the government to do everything on time. Hopefully, and over the years that has kept on improving. The government agencies have tried to be more coordinated. I can only hope and wish that the central government also takes notice of that and focuses on better coordination amongst all the different agencies so that these infrastructure projects, which usually get delayed a lot. And if you look at the last 20, 30 years of infrastructure project building in India, probably 75% of them have gone over the stipulated time that the government initially envisaged. And eventually it led to cost escalation. So that's, making sure that all the different parts are fitting beautifully. That's what probably would is the biggest concern always. Nothing that is specifically keeping me up now. I think COVID was probably that time. But going forward, I think there are so many different levels of growth. I'm not particularly fussed about it. And also, I'm excited about this journey that we have embarked upon, where we are looking at building different asset classes and also building partnerships with, financial partners such as Alpha. So those are the things that I'm currently very excited about. And I think there is, all this transformative journey that we have kind of undertaken should showcase a very different deliberate one in the next 2 years.
The co-founder of Microsoft and the Gates Foundation, Bill Gates, is back in India in an exclusive conversation with the NDTV network. Here's what Bill Gates has to say about India's digital infrastructure, the evolution of AI, and more. Listen in to a slice of his conversation with my colleague Vishnu Shom.
Well, there's no doubt that being able to register citizens and get government payments to them directly, they don't have to go to a bank branch, nobody's asking for their part of that cash. The pandemic is a wonderful example where actually going to branches wasn't going to work no matter what. And so the amount that's been saved, and now the amount that the government's interacting in a rich way with citizens. For example, I saw in Odisha where they'd registered the farmers and they understood their land and their crops. And so they're sending them a regular bulletin and they're communicating about pests and what you need to do. So this is a case where India's been out in the lead. India did this thing at scale. They made it work, and the Gates Foundation has been involved in some of those projects. But we're also involved in helping India show other countries. So right now, there's 15 other countries at various stages of adoption, which a lot of that was kicked off by the way that Modi made that a centerpiece of the G20 meeting.
It's ultimately about empowerment, right? It's not just about efficiency, it's about empowering people, women, young adults. And do you believe that's a model that needs to be replicated elsewhere?
Well, definitely. Paperwork in government and being confused about different policies and, having the powerful people sort of take away the payments that should come to you. These systems are really critical. Even like collecting the GST or understanding what's going on with the population. We'll see it get richer and richer in verticals like health and agriculture. And every time I come to the country, I get updated, whether it's by government groups like in Odisha, entrepreneurs like Nanda Nilekani sit me down and show me what he's seen. And, we're pleased to be a partner both here and in the global quest.
Could you tell us a little bit more about the Odisha visit? I do know that there was a lot that you were shown in terms of hard data backing agricultural growth. What exactly did you see, and how do you feel that that's something that potentially works or does work?
Well, you've got a lot of farmers, and you can never have enough extension workers. I love extension workers. They're very important. We can empower them to be more productive. But this idea, if you have a record of, okay, where is my land? What are the crops that I grow? Take the latest satellite data and see, okay, are they maturing well? Take all the reports of insects or other pests. Look at the weather forecast. The expertise that a big farmer can afford and almost takes for granted, we can now make sure that even the smallholder, is getting the benefits of all this expertise. And so it's digital farming, and it's all about equality.
And, since we are talking about digitalization and technology, we are in an era when artificial intelligence is something which affects all of our lives at so many levels. I think the most obvious question to ask you is, there is a huge concern that a lot of jobs would disappear across sectors, and yet artificial intelligence at so many levels is indispensable. So how do we sort of handle this concern?
Well, we're not going to have anytime soon an excess of labor. We can reduce class size. We can take care of old people. We can take care of handicapped kids. If our society is so productive, we can even reduce the work week. But until we meet a lot of these needs, do we have enough doctors? No, we'd like to make them a lot more productive. Individual tutoring is the way to teach kids the best, but without more productivity, it's only affordable for a very narrow group. And so you have to go a long ways at upping productivity before you get to the point where you can say, okay, let's have a shorter work week. But that's a good outcome.
So fewer jobs as a result?
Not anytime soon. I mean, the world has more jobs today than it had 100 years ago. 100 years ago, you had to toil in a backbreaking way just to barely get enough to eat. That was 80% of people were farmers. Now we have these demands, people want manicures, people want time to be entertained, they want a lot of things, and so the advances we've had have made our life a lot richer. We've reduced the work week some, but that hasn't been the primary thing. Primarily, the food we're offered, the entertainment, is just way richer than what our previous generations could even dream of.